Welcome to Talk Tickers. Today we're diving straight into the latest earnings call to really pull out the key insights you need on this company's performance.
Absolutely. And, this quarter was, pretty much a story of steady progress. Total company sales were up 1.7%.
Okay.
But that number jumps to 4.4% if you look at it on what they call a daily constant currency basis. Accounts for trading days and currency swings.
Right, a cleaner comparison.
Exactly. And importantly, operating margins, they stayed strong, 15.6%.
That's solid.
Very solid. Diluted EPS hit $9.86, which is a 2.5% increase compared to last year.
Okay, nice little bump there.
Yeah, and they generated good cash flow too, $646 million operating cash flow.
And getting cash back to shareholders.
Oh yeah, $380 million returned. That's through dividends and share buybacks.
Good to see.
And speaking of dividends, they actually increased the quarterly payout by 10%.
Wow. 10%.
Yeah, and this marks the, get this, 54th consecutive year they expect an increase.
54 years. That's quite a track record.
It really is. So, the big picture, the quarter pretty much landed where people thought it would, and they're saying they're on track for their 2025 guidance.
Okay, good overview. So let's drill down a bit. How did the different parts of the business, the segments, perform?
Right, so they've got two main divisions. First, high-touch solutions. Now, reported sales were down slightly, about 2%.
Mm-hmm.
But again, on that daily constant currency basis, they were actually up 1.9%.
So underlying growth is there.
Exactly. Driven by volume and some modest price increases across all geographies. In the U.S. specifically, they saw strong performance with contractors and in healthcare.
Which helped offset weaker areas.
Yeah, manufacturing growth was apparently a bit slower. But the gross profit margin in this segment improved nicely, hit 42.4%. That's up 60 basis points.
And why was that?
They pointed to a better product mix, selling more profitable stuff, and also some good deals with supplier funding, they called it.
Makes sense. Any negatives?
Well, their SG&A costs, selling general admin expenses, they went up.
Okay.
Partly due to investments to generate more demand, marketing and such. And also they had their big annual sales meeting this quarter.
That'll do it.
Right.
So operating margin?
Landed at 17.7%. It's down just a bit year over year, but actually better than they were expecting for the quarter.
Okay, so high touch, holding steady, maybe a little better than feared.
Yeah.
What about Endless Assortment? That's been the growth engine, right?
Oh, absolutely. And it continued to be. Sales were up 10.3% reported.
Nice.
And on that daily constant currency basis. And even stronger, 15.3%.
15%. Where's that coming from?
A lot from the U.S., which was up 18.4%. And their Monotaro business up 13.6% in local currency.
Wow.
Yeah, and within that, the Zoro platform is showing really good traction with B2B customers, better retention too.
Okay.
Monotaro's growth came from bigger enterprise clients and also just solid performance with SMBs, small and medium businesses, getting new ones and keeping them buying.
And profitability and Endless Assortment.
Improved too. Operating margin for the whole segment reached 8.7%. Monotaro itself hit 12%, and Zoro got to 5.2%.
Good progress, especially for Zoro.
Definitely. And their gross margins were better than expected as well, mostly due to some pricing moves that weren't related to tariffs.
Okay, interesting. Now, you mentioned tariffs. The call also touched on market outgrowth, right? How they're doing versus the overall market. What's the story there?
Yeah, this was a pretty key discussion point. There's this weird divergence they're seeing.
Divergence.
Yeah, between the traditional benchmark, the Industrial Production or IP Index, which focuses on manufacturing.
Okay.
That benchmark suggests the U.S. MRO market maintenance repair operations grew maybe 1 to 1.5% in volume.
Right, modest growth.
But the company's own internal model, that actually points to a slight decline in MRO market volume, low single digits.
Huh. So if their model is right, they actually outperform the market by quite a bit.
Exactly. Several hundred basis points of outgrowth, potentially. They think tariffs might be sort of inflating that IP benchmark right now, making it look stronger than the reality they see.
Interesting theory. So how are they handling this uncertainty?
Well, because of this, they're actually shifting how they report outgrowth. They're moving to doing it just once a year, annually, instead of every quarter.
So less frequent updates for us.
Yeah, makes tracking it quarter to quarter harder. But they were clear this reporting change doesn't impact their full year sales guidance for high touch or their long-term goals, including that target of 400 to 500 basis points of annual volume outgrowth.
Okay, so the underlying target isn't changing, just how they talk about it quarter to quarter, because the benchmark might be noisy.
Precisely. It highlights for you, the listener, that maybe you need to be careful just relying on that IP number right now, especially with tariffs muddying the waters.
Speaking of tariffs, obviously a huge topic.
Yeah.
What's the company saying about navigating that whole landscape?
Yeah. They stressed it's still pretty early. Things are moving. Adjustments are happening. They've only recently started really digging in with suppliers on these tariff-related cost increases.
So negotiations are ongoing.
Pretty much, yeah. Not fully done. And figuring out the real impact takes super granular product-by-product analysis, inputs, where it's sourced, freight, all that.
Right, it's complex.
Very. They have taken some initial pricing actions, mainly on stuff they import directly that got hit by those Section 232 tariffs and the first China tariff was.
Okay, direct imports first.
Right. For most other products where they buy from suppliers who might be importing, price adjustments will likely come later once they actually see those costs coming through.
Makes sense. What's their goal with pricing?
Ultimately, they want to mitigate the hit and get to what they call price-cost neutrality over time, basically pass through the costs eventually.
And do they feel particularly exposed compared to others?
They said they don't believe they are, no. Not uniquely exposed compared to competitors.
Okay. And how does this feed into their guidance for 2025?
Well, they reaffirmed the guidance, but it kind of assumes that any price hikes due to tariffs will be offset by slightly lower demand. So net-net, that price-cost neutrality holds.
Okay, a balancing act. What about the immediate next quarter, Q2?
They're expecting sales just north of $4.5 billion. That's about 5% daily constant currency growth. And that includes a small expected tailwind from those initial tariff price increases they've already put through.
And margin for Q2?
Targeting at or near 15%. There are puts and takes there, normal seasonality and gross margin, tariff impacts, getting some leverage on SG&A, timing of expenses, lots of moving parts.
Always is. Okay, let's shift to the Q&A part of the call. We'll often get some good nuggets there. What stood out?
Yeah, definitely. One point was about Zoro's profitability improving. They stressed that it's sustainable, driven by, actual revenue growth and operating leverage kicking in.
Good to hear. It's not just a one-off.
Right. They also sounded pretty confident about hitting their overall company target mid-single-digit growth, leading to a 20% consolidated contribution margin.
Even with tariffs.
Yeah, they kind of acknowledge that if tariff pricing boosts revenue but dampens volume a bit, they might still hit that margin goal, perhaps at a slightly lower growth rate overall.
Interesting. What about sourcing, especially from China?
They said they've done a lot of work over the last few years to understand and diversify their sourcing. But, they admitted some categories are still pretty heavily reliant on China, and moving production, well, it takes time.
Sure does. Are they seeing customers pull back yet because of all this uncertainty or potential price hikes?
Apparently not really. They said April actually saw accelerated growth. They expect the tariff demand impact to be, modest at first, maybe more later. And most customers seem to think the tariffs will be manageable.
Okay, that's somewhat positive.
Yeah. They also clarified the initial price hikes were mostly direct imports, plus some selective ones from suppliers. Net impact so far, maybe 1 to 1.5%. But the broader effect of higher tariffs, still uncertain.
Right. And they doubled down on their internal MRO model being better than the IP data.
Yeah, basically said it's more accurate, even if it's more complex.
What about private label? Higher China exposure there?
They said yes, generally higher than national brands, but maybe less difference than you'd think. Navigating tariffs on private label will be sort of case-by-case, balancing price versus volume.
Makes sense. Supply chain resilience is obviously a concern if things get really messy with U.S.-China trade.
For sure, especially for key categories. But again, they don't think their private label exposure is uniquely bad compared to competitors.
Did they talk about maybe gaining share in this environment? Sometimes uncertainty helps the big players.
They did. They see a potential opportunity, yeah, like they saw during other volatile times, like the COVID supply chain chaos. But they also admitted the path forward this time is maybe less clear.
Understood. Any tension between the guidance for high touch versus endless assortment?
No, not really. They basically maintain the overall guidance based on what they know now and seasonal trends. Potential upside from pricing isn't fully baked in yet, it seems. Market volume assumptions are still, flat to down.
Okay. Any other customer trends?
Yeah, varied performance. Government was apparently kind of weak, but some manufacturing segments, like aerospace, were strong.
And supplier price increases, are they flooding in?
Sounds like it's been varied so far. And the impact on the P&L takes time because of inventory turns, right? So more impact likely in Q3 and beyond.
Right, lag effect. Did they touch on private label margins versus branded?
Briefly, said the discount and margin difference varies a lot by product, but they did caution that really big sustained tariffs, they threw out a number like 145%, could hurt private label competitiveness and margins, at least in the short run.
Oof, yeah. And freight costs, part of the tariff impact.
Freight's a mid to high single-digit percentage of their cost of goods sold. Most of the tariff impact hits the product cost itself, but yeah, you need that detailed product level view to see everything.
Okay, so pulling this all together, what's the kind of big picture takeaway for someone trying to understand where this company stands now?
Well, I mean, it really looks like a company navigating a pretty complex world with reasonable stability. Endless Assortment is clearly the growth engine, still performing very well.
Right.
High Touch is, adapting, doing okay, managing varied demand. Tariffs are the big wild card, the uncertainty. They're actively managing it with pricing, talking to suppliers.
But it's still unfolding.
Exactly. The fact they reaffirmed guidance suggests maybe some cautious optimism despite those headwinds. And that shift in reporting market outgrowth, it just underscores how tricky it is to read the market right now with trade policies shifting.
So for listeners, keep an eye on how those tariff strategies play out. Pricing, demand impact.
Definitely. And maybe form your own view on market growth, considering that difference between the IP data and their internal model.
All right, perfectly summed up. Now let's switch gears slightly. It's time for our This Is Not Financial Advice segment. Purely speculative, outrageous, but plausible trade ideas based on the discussion. What's your first one?
Okay, so thinking about how they talked about hitting direct imports first with price increases.
Right.
Idea one, short companies that are heavily reliant on direct imports but might lack pricing power.
Okay, unpack that.
Look for competitors maybe or downstream industries where a huge chunk of their costs comes directly from imported goods and they operate in super competitive markets where they just can't easily pass on big price hikes without crushing demand. Think maybe some consumer discretionary areas or cutthroat retail sectors.
Interesting vulnerability to target. Okay, outrageous idea number 2.
This one plays on the private label and sourcing discussion. Idea 2. Long companies that have sourcing flexibility and strong private label brands aimed at value shoppers.
All right, the flip side.
Yeah, so companies that already have good private label lines but aren't totally locked into, say, China for sourcing, maybe they've diversified. If tariffs bite, value shoppers might shift more to private label, and companies that can adjust their sourcing quickly to keep prices reasonable could really benefit. That agility could be a key advantage, potentially letting them grab market share.
So flexibility and appealing to the cost-conscious consumer in uncertain times.
Got it.
2 interesting, if outrageous, ideas to mull over.
Exactly. Just food for thought.
Definitely. And that wraps up our rapid-fire analysis of this earnings call. We aim to give you that focused understanding of, the key numbers and the strategic thinking behind them.
Remember, this deep dive is really about giving you context, helping you connect the dots as you navigate the market.
Absolutely. We encourage you to think more about these tariff implications, how that might play out, and what that shift in outgrowth reporting really means.
This has been a special deep dive, giving you a concise but hopefully comprehensive look at this important earnings announcement.
Stay tuned to Talk Tickers for more sharp analyses coming your way.